What's going on, guys? Mike here in today's episode 2 of the beginner series on the Canadian Biweekly Investor channel. And today we're going to talk about two important things. One, I kind of a little bit of a recap from the last video, but reevaluating what a stock is. And the next one being bonds and their importance of having them included into your investing portfolio. So without any further ado, let's just get right to it. So again, a stock or equity being the same thing, depending on who you're talking to or what they refer to it as, is the ownership of a company. So if you buy one stock of Home Depot or TD or TELUS or whichever the case may be, you actually become an owner, a part owner of that company. Now, of course, being an owner of the company, you are a part of their successes and you get to also be a part of their failures. So typically, the equity market is always labeled as more of like your biggest returns, but your biggest risks, right? So kind of some highlights I want to talk about in regards to the equity market, though, is over the course of 80 years in the U.S. stock market, there's been an average return of around 9 to 10%. So in comparison to bonds being around 4 to 5, right? So you can see, double the return, but again, maybe it's double the risk, I guess, depending on what you're investing in. So it's just kind of something to realize. But now the bulk of your money generating in your portfolio is going to come from the equity market. Okay. Now, some things you can do to de-risk your equity holdings within your portfolio. Now, we will get more into a deeper dive into this and do a future video, so definitely subscribe if you're interested in this. But we're going to dive deeper into like how to construct or how to get a more diversified portfolio to de-risk your portfolio. But just on the topic of equities, as a very high level, you can kind of like de-risk the high risk of equities by just being diversified and investing into quality companies, right? So if you're going to invest in a lot of like startups or penny stocks, well, you're basically gambling. You might actually be better off going to the casino almost. But if you're investing into top quality companies like Google, TD, Enbridge, any like railway company in Canada, whichever the case may be, right? We won't get into the further details of that, but investing into quality companies and also having an allocation limit, right? So instead of like say putting all your money into say TD Canada Trust, diversify it. Maybe you don't want to go anything higher than 2.5% or 5% of your overall money in your investment portfolio into one single stock, right? So again, because if you have say 100 different individual companies, well, the chances of all of them defaulting are next to nothing, right? It's probably not going to happen. If it did, the world's probably falling apart. But the chance of one, yes, it's going to happen at some point, right? Maybe you'll be lucky, maybe that won't happen. I haven't had it happen to me, but you just never know. So, like I said, you can de-risk the high risk by being diversified and not putting all your eggs in one basket, right? So, and again, like if you look at my Wealthsimple portfolio that I reveal here often, you'll see I have some that are currently winning and some that are currently failing, but overall the portfolio is up, right? And that's the main goal. So that's stocks, right? So now going into bonds, you kind of have two different kinds of bonds we're going to focus on in this discussion: buying an individual bond as well as buying a bond ETF or a bond fund. So an individual bond we're going to start with. I personally don't, I have never purchased an individual bond myself, but I'm going to kind of share what I've learned myself, and maybe it'll help you guys out. So when you're looking at a bond, it's going to kind of have like three different areas. One's going to be like the price of the bond, the coupon rate of the bond, and the maturity of the bond. So the price of the bond, let's just say we're going to buy a government bond, and there's lots of different types of bonds you can buy. You can buy government bonds. You can buy, kind of like a junk bond, which is like more like your high risk bonds. Sometimes they refer to them as junk bonds, but like they pay the highest interest rate because they're like the most riskier. They're the highest risk out of the scale of bonds. Government bonds being like the lowest risk because of the chances of the government defaulting on a loan is hopefully next to nothing. And then you kind of have your high quality corporate bonds, which are like maybe like an Enbridge kind of thing. But let's just for this example, we're just going to be buying a government bond. So let's pretend a government bond at $10,000, a coupon rate at 3%. So 3% is the annual interest that it pays. So if you're giving them $10,000, they're going to be paying you $300 a year in interest based on the coupon rate, and the maturity rate being how long the bond lasts for. So in this example, let's just pretend 10 years. Okay. So you buy it, you start collecting your $300 a year in interest, which is awesome. It's kind of like your fixed income, right? It's kind of basically the closest thing to a guarantee, essentially. Also too, one thing to realize though is that the bond value can change. Now, the bond value only really matters if you're looking to sell it. Otherwise, if you hold it for 10 years, you're going to get your 3% every year, and then at the end of the 10 years, you're going to get your $10,000 back, and of course, you accumulated your $300 for the last 10 years. So now, if you want to sell it, now, if for whatever reason you bought it at 3% in year one, and then the next year you want to sell it. So what ends up happening is that, let's pretend the overnight rate has gone up, kind of like in the environment we're in now. So you bought it for $10,000. A new bond, let's pretend, is now selling for $10,000 from the government, but at 5%. So who's going to want to buy your bond at $10,000 for a 3% return when they can go buy a brand new one for 5%? So what does this do? It lowers the value of your bond, right? Kind of makes sense, because I wouldn't want to buy a 3% bond if I can just buy for the same price a 5% bond. So what ends up happening is you need to kind of lower your price of your bond if you're trying to sell it, so that it works out to be that the guy would get like 5% average, right? And that also happens in the reverse effect. So if you buy it at 3% and the Bank of Canada rate goes down, and so a few years later you're going to go sell it, maybe your bond is now worth $12,000 because the current interest rates on bonds are 1%, right? That's just kind of the way she would go. So again, though, this you don't have to worry about if you have no intentions of selling it, right? So if you buy it for $10,000, you're going to hold it for 10 years, you're going to collect your $3,000 in interest and get your $10,000 back. Perfect. So the other thing in regards to bonds is like I said before when I was comparing their stocks, is that their average rate of return over the last 80 years has been around 4 to 5%. Now, in my mind, I kind of feel like that's potential is probably gonna be lower, because like if they're gonna compare, to 80 years from now, from 80 years ago, then like we're comparing to rates when they were like 15% or 10%. So if you think in your lifespan, have you ever been in an interest environment of 10 plus or double digits? Probably not. So that average, I believe, will probably come down the longer we go, potentially. Or, I hope we never get to double digits interest rates again. That would be awful when people are leveraged way more than they once were back in the day. So just something to kind of be cautious of, right? So bonds, are they important to have in your portfolio? Now, I do believe that they are important. So one thing that people do is they typically will run the 100 minus your age rule. So 100 minus your age, so if you're 30 years old, 100 minus 30, that means you should have 70% equities and 30% bonds. Now, the reason for the 30% bond allocation is to de-risk your portfolio overall, right? So, because again, equities typically do this, and bonds are a lot less, right? But also with having more bond allocation, the chances of higher returns are less, right? But again, having higher bond allocation, the chances of losing are also less. So we're going to kind of go over that in a future video as to like how I decided what I wanted for my own bond allocation. And just so you guys are aware, I personally don't follow the 100 minus age rule personally. I personally right now I'm a 90-10 and I'm 33 years old. So I have 90% equities, 10% bonds. So yeah, you kind of just have to ask yourself, what you're kind of looking for, what you want out of it. So anyways, we'll cover that in a future video. But yeah, so one, I don't follow the 100 minus 10 or minus age rule. Again, I'm just kind of sharing everything that I've learned, as an investor, and what the industry standards are, and kind of just what I do. And then you guys can choose for your own selves as to what you want to do. Again, I don't buy individual bonds. What I do buy is ETF bonds. So a bond ETF or a bond fund. So I'll kind of get into details as to what this is. So I'm going to show my screen here. And the bond fund that I use, that I have 10% of my money allocated to, is ZEG, which is through BMO. So a bond fund is just like a stock, right? You can buy it at current price. As of the market close was $13.88. And it fluctuates as well, right? So you can look over the course of, I guess their max would be, so going back to 2010, you can see how it drops here in this high interest change. I'll explain why that's happening. And yeah, so you can kind of just see it, right? So just kind of highlighting over this here first, you'll see here that their average distribution yield is 3.49%. So that's like your coupon rate, right? Now this will technically fluctuate as the price fluctuates. So if this went up to $15, this would probably be closer to 3 because you're buying it at 15 versus 13.88. If the price drops to say 12, this would be closer to 4%. So right now 13.88. Now the most important thing when buying a bond fund is, one, you need to know the maturity rate. So the maturity rate on this guy here, weighted average duration in years, is 7.37 years. So if you're going to be looking to buy this particular bond and sell it in 3 years, there's a pretty good chance that you're not going to maybe make money on it, or you may not make anywhere close to the maturity of that 3.49 yield. When it says, basically when you're looking at the bond fund, you're basically looking at the maturity years, and if you hold it for the 7.37 years, you're in theory going to walk away with roughly 3.49% return, right? Which is the current payout of the, because they pay out the interest in a monthly dividend. And so yeah, you could pretty much calculate, you could pretty much bank on that dividend for the next 7.37 years. And in theory, the stock price will be roughly around that 13.88 potentially, or maybe it's higher or lower, and we'll go into details as to why in just a few minutes. But yeah, so like I said, it's very important. So if you're looking to, say, buy into a bond fund and you're only planning on keeping it for a year, there are bond funds that have an average maturity rate of 1 year, right? They're just kind of short-term bonds. That's basically what they are, or short-term bond funds. There's also long-term ones that are like 10 plus years, and so on and so forth. So you have to kind of, again, do your own due diligence and kind of figure out what you want. Maybe you want no bonds, or maybe you want lots of bonds. It's kind of up to you. So that's kind of what I was saying. So again, what kind of contributes to the 13.88? Well, it's kind of like an individual bond situation as well. So you can see right now from 2020 to 2023, we've dropped significantly in the price. Right now, the reason for that is again, we were, this is a bond that has over 7 years, so they probably have some at 25 and some at 1 and some at 7 and some at 5. But their average is about 7.3 years. So they're going to have a wide spectrum, and they'll have it on their website as to what each bond that they own and what their payouts are on each of them. But as the interest rate of the Bank of Canada raising the overnight rate is so much higher, so what ends up happening is it brings down the value, because now if the ZEG is going to go sell bonds, they're probably having to sell them at basically a discount or lower than what they originally purchased them for, right? Same thing again happens in reverse. Once the Bank of Canada interest rates come back down, then the bond fund will go probably back up, because now we just bought a bunch of bonds at a higher interest rate. And now if we go to sell them, well, the bond fund goes up in value. So again, this is why it's kind of important, if the maturity rate is 7 years, that you kind of hold for around that as well. Because if you just bought in 2020 and then you needed to sell now, you're definitely losing money, right? So that's the problem. So same thing could technically happen on a bond, individual bond. If you bought it in 2020 and then you tried selling today, you probably are not making any money. No one probably wants to buy that bond because it's so little interest compared to the brand new ones that they can buy today. But the difference is, it's like this one's visible, right? Like you visibly see in the stock market the capital price going down, which obviously sparks emotions, and you're like, oh my, I'm losing money. But again, it's always about the maturity rate. So if you're buying into bonds, maturity rate is very important. Okay. So that's kind of the biggest differences. Like you can buy individual bonds, the bond funds, and so on and so forth. And so, like I said, there's like a whole bunch of different bond funds you can buy. You can buy like just corporate bonds that are going to have a bit of a higher interest rate because, of course, they're in more risky companies potentially. You can buy like specifically government bonds, or so like there's so many different ones you have to go through and just check them all kind of out, right? So, like I said, I personally am not necessarily following the 110 rule, or sorry, the 100 age rule for bond allocation. I'm 33 years old and I'm doing a 90-10 mix. I'm trying to, obviously, I have 30 plus years of investing, and so I'm trying to capitalize on being able to get bigger returns, right? I'm gonna freak out and sell a lot of the stocks because maybe I'm down on quite a few of them right now. It is what it is. That's the market we're in. And I showed in my last video that if you're in the stock market for 20 plus years, you have a 95% chance of having a positive return. Definitely check that out in the first video if you want to get a little bit more information on that. But long term is 95% chance you're going to do just fine, right? So again, in these fluctuations, we're just going to leave it. It is what it is. And that's kind of why I'm less on the bonds. I don't necessarily feel like some people will have more bonds just so that it de-risks it, and it helps them cope with these down times. And that is totally acceptable. If that's something you need to do it, right? Because you want to be comfortable with your investments, right? You don't want to be in a position that makes you not being able to sleep at night. That is not good. So but yeah, so like my current plan, and my plan will probably change over the years, but my current plan is to stick with my 90-10 until I hit 40, and then I'll probably do 80-20. And then when I hit 50 years old, I'll probably do about a 70-30, and when I'm 60 years old, I'll probably do like a 60-40 or maybe a 50-50. Again, that's 30 years from now, so a lot of things will probably maybe change, but I'm always like having a plan and then being able to adjust the plan. I always like knowing where I'm going, and it's always great to reevaluate the plan every year, right? So just so you guys know that as well. All right, guys, well, I hope this was helpful, and my next video, I'm hoping to do kind of the ETFs and mutual funds and their differences. So like I said, if you have any questions or comments, definitely leave them below. Definitely subscribe if you're interested in future content of this channel, and I'll see you guys in the next one.